guys, and welcome to your 2-Minute Money Manager. I'm your host, Stacey Johnson, and this answer is brought to you by MoneyTalksNews.com, serving up the best in personal finance news and advice since 1991. Today's question comes from William. William says, the president recently tweeted that the Federal Reserve should lower interest rates to zero or even to negative rates. What should the average saver nearing retirement do with their savings? So let's take a minute, guys, and understand interest rates, why they go up and down, and then we'll talk about negative rates too. Okay, back in the early 80s, when I began my career as a Wall Street investment advisor, you could get a perfectly safe savings account that paid 20% interest. Can you imagine that? Those were the days, at least if you were a saver. They were horrible if you were a borrower. But anyway, as you well know, if you're a saver today, these days, it's hard to earn 2% on your savings. And just when you think it couldn't possibly get any worse, now you start hearing about the potential for negative interest rates. As William points out, President Trump last month tweeted, I quote, the Federal Reserve should get our interest rates down to zero or less, end quote. Now, the reason the president wants lower rates is that low interest rates stimulate the economy, and good economies help re-elect presidents. Low rates do help the economy in several ways. For example, both consumers and companies are more likely to spend if they can borrow inexpensively. After all, less interest we're paying, the more money we have, and the more money we spend, the more the economy grows. So that's a whole key. That's why people want interest rates to be lower. Low interest rates also cause a nation's currency to weaken against those of other countries. And that makes it cheaper for other countries to buy our stuff, our exports. So this boosts our exports, which also obviously stimulates the economy. Low rates can also help the stock market. Since businesses pay less interest, they're obviously more profitable. More to the point, though, when bank interest rates are horrible, like they are now, investors will seek out other options, like the stock market. So although low interest rates aren't good for savers, they can get the economy moving. Now, let's move on and talk about negative interest rates, because this is fascinating stuff. You would think that the lowest an interest rate can go is zero, right? Hey, I feel you. I've been doing this stuff for 40 years, and I'd never heard of negative interest rates either, at least until a few years ago, when negative interest rates started popping up in Europe and Japan. Negative rates, as that label implies, are the mirror image of typical interest rates. You know, normally when you put money in the bank, they pay you interest, right? When rates turn negative, though, you're literally going to pay the bank to hold your money for you. I know this is hard to understand. I mean, it's just so weird to wrap your mind around. But the important thing to understand about negative interest rates, though, is they're not really aimed at you, the consumer. Negative interest rate policies really are trying to target banks. Let me explain that. Just as you park extra money in a savings account at your local bank, banks park their excess reserves with the nation's central bank. Now, the U.S. central bank is called the Federal Reserve. And just as you earn interest on your savings, banks earn interest at their central bank on their deposits. But if that central bank starts charging interest instead of paying interest, well, guess what? Banks are going to be motivated to take that excess money out of that central bank and do something else with it, like lend it to people like you and me, and businesses too. After all, isn't it better for them to earn even 1 or 2% than by lending that money than to pay to keep their money at the central bank? Absolutely. And so what we've done is we've done the same process I just described. We've goosed the process. Consumers and businesses are getting cheap loans, which results in more spending and a growing economy. So here's the bottom line of that. The idea behind negative rates is to basically force banks to lend money. Now, here's a question, though. I said this is mainly aimed at banks, but could consumers see negative interest rates? It is certainly possible that negative interest rates could flow through to the consumer. In other words, should negative rates arrive on our shores, we could be forced to pay to keep money in a savings account. Or on the other side of the coin, now get this, we could theoretically get a mortgage that pays us. Get that? Mortgage is paying us interest instead of us paying interest to the lender. In fact, this has already happened in Scandinavia. Not long ago, a Danish bank started offering mortgages with 0 and negative interest rates. Now, with a negative rate mortgage, instead of paying interest, you're literally going to pay back less than you borrowed. Isn't that wild? But it isn't the norm, though. In countries with a negative interest rate policy, it's usually the banks that are being charged to park their money, not consumers. Nor, despite the example I just gave you, are consumers typically able to get paid to borrow money. But it is still possible, though. Now, are we going to see negative rates in the United States? Some people think we are. In fact, I don't know if you've heard of Alan Greenspan. He's a former Federal Reserve chairman, widely respected. He recently said on CNBC, you're seeing it, meaning negative rates, pretty much throughout the world. It's only a matter of time before it's in the United States. Whoa. So what's a saver to do? You think rates are bad now? How about if they go negative? What are you going to do? Well, several weeks ago, I wrote an article called 5 Reasons I'm Partially Dumping Stocks. And from that article, here's a quote. We're now in the longest economic expansion the nation has ever seen. While it's certainly possible for the party to continue, we're definitely closer to the end than the beginning. In short, I think odds are good that we're going to see a recession in the next year or two. Now, when that happens, rates that are already low will fall farther as the Fed attempts to stimulate the economy, just like I was telling you before. Rates may or may not become negative, but either way, it's going to be bad news for those attempting to live off the interest on their savings. So what should you do? Well, for one, use certificates of deposit to lock in rates now, as we've suggested in multiple articles at moneytalksnews.com. You can go to our Solution Center and you can look up the best rates on CDs right now. So go to moneytalksnews.com, Solution Center, upper right-hand corner, and then look for the best CD rates and maybe lock some in today. Now, I'm not saying lock up all your savings now. You got to keep some powder dry. After all, I could be totally wrong. And rates may not go down. And it wouldn't be the first time I've been wrong. So, don't put all your eggs in that basket. But after you do lock in some of your savings now, think about other investments. There's lots of other things besides CDs at the bank. There are stocks, mutual funds, bonds, peer-to-peer lending, real estate. I've written about all this stuff. Just go to moneytalksnews.com and do a search for earning more on your savings, and you'll come up with tons of articles. Well, I hope that answers your question, William. And if any of you folks out there have a question of your own, all you have to do is subscribe to our free newsletter, hit reply when you get it, and ask your question. I don't answer all of them. I don't have time. But you might see your answer, or your question rather, on a video just like this one. Hope you guys have a great day. I'm going to see you right here next time.